Welcome everyone. This is episode 6 of the Stablecoin Builder series. This webinar is a monthly live session for founders, entrepreneurs, and operators building products in the stablecoin space. We cover topics for projects at every stage of growth, from idea to funding to shipping. We run these sessions to help the stablecoin ecosystem grow by tackling real infrastructure challenges together. A quick intro for those who are new. Utila provides fintechs, banks, and enterprises with infrastructure to build and manage stablecoin and digital asset operations. We serve over 200 institutions across payments, treasury, trading, and more, and help secure over $20 billion in volume every month. For today, again, thank you for everyone for joining. We are talking about yield in practice. Yield is becoming a core product feature across fintechs, exchanges, and wallets. And the teams that get the implementation right are the ones that will capture the meaningful institutional capital as stablecoin adoption continues to grow. So today we're going to move past the market structure conversation and get into the actual decisions, capital allocation, permissions, risk controls, and what it takes to run yield strategies in production at institutional scale. So we have 4 operators here today, and we're going to do exactly that. I'm looking forward to getting into it. And if anyone has any questions, feel free to drop them in the chat throughout the webinar. We will address them at the end, as many as we can. So let's get into it. I'll start with quick introductions for the folks on the webinar today. Sort of round robin. Ryan, I'll let you start first.
Hi, I'm Ryan with Coinchange, and I direct our strategic partnerships. And we operate as a multi-strategy, multi-fund yield component, building portfolios that are risk-based and making them available through strategic partnerships through our APIs.
Excellent. Thank you so much, Ryan. Adam, Gaia, Matt, whoever would like to go next, and then we'll get into it.
Happy to go further. Hi, hello, everyone. I'm Gaia. I'm the CEO and co-founder of Byzantine Finance. Byzantine builds cash plus products for banks, brokers, institutions that either have treasuries of their own to invest, or for their clients to offer higher yields on saving accounts.
Excellent. Thank you so much for joining. I'll let Adam, Matt, whoever would like to go.
Yeah, I'll take this. Hello, I'm Adam Haeems, Head of Asset Management here at Tesseract. We're a MiCA authorised CASP out of Helsinki in Finland, and we're supervised by the Finnish FSA. We do 2 things currently. We run dedicated client vaults, so 1 per client, segregated on-chain vaults for regulated institutional yield. And we operate an institutional lending business, so lending crypto directly to institutions day by day.
Awesome. And Matt, we'll land with you.
Sure, no problem at all. Thanks very much for the quick intro. So Matt Molloy, CEO and co-founder of TruYields. We're the institutional yield engine for on-chain markets. We provide permissioned access to both liquid staking, tokenized real-world assets, and curated vault strategies. Today, kind of institutions typically use TruYields to generate sustainable yield on-chain through the same secure infrastructure and kind of disciplined risk management as we had on the liquid staking side origination.
Excellent. So yes, we've got 4 real operators in the space with us today to discuss. I'll kick it off. We can start by talking about yield strategies and product design. First question would be, what stablecoin yield strategies are available today? Lending, staking, restaking, RWAs, structured products, and how do you think about which ones to offer inside of a yield product? I'll let, I can round robin it, or whoever would like to go.
I don't mind taking it. I can start. I can talk about what we do here at Tesseract. So we classify strategies by how the yield is actually earned, not really by a marketing label, so to speak. So we have two distinct buckets that matter to us mostly. We have organic protocol lending, which of course is probably the most common, and we define and build structured carry strategies. So each of these are quite different. They have different risk signatures and belong in very separate risk tiers, and that's how we manage our on-chain portfolios. So we look at the organic rates on the supply side lending. So we mainly look at lending to blue chip money markets. So these are things like Aave V3, Morpho. And these are kind of more conservative strategies, right, where we don't have any leverage, there's no looping, and there's no structured exposure. Then we have those on more advanced strategies, things like structured carry and basis strategies that we build. That includes leverage looping across lending markets and some futures basis strategies, which now we've seen more of on chain. We build these generally in self-contained vaults, right, with their own risk management logic. And we're obviously, of course, seeing the vault world on chain grow massively. Research-wise, we are kind of looking into RWAs. That's a hugely growing area in on-chain. We're still kind of in the research phase. We haven't yet significantly deployed into RWAs, but we do have exposed to things like Maple and other things like that. But yeah, we're still yet to explore RWAs thoroughly.
Excellent. Anything to add there, Matt or Gaia? I'm curious what your approach is.
Yeah, sure. Happy
Yeah.
to kind of. Oh, sorry, Guy. Sorry.
Go ahead.
Yeah,
Go
just
ahead.
thank you. Yeah, I was just going to add to that, maybe somewhat similar to what Adam mentioned, but just following on to the RWA side. TruYields, we recently launched or will be launching kind of an upcoming treasury bill focused product, and we've obviously seen the huge growth in the market on tokenized RWAs in terms of being a sustainable and generating on-chain yield opportunities for those that want US dollar denominated yield. Products like Biddle for BlackRock and others, some of the largest kind of assets on chain in the RWA space, and there's certainly a lot of growing demand on that side for generating yield that has come from outside of the crypto space and representing that value on chain. We see that in kind of one kind of safe and secure bucket, and we've got a lot of clients who are asking for that just in order to actually hold and access. But another area of yield which we're kind of focused on more around the curated vault, similar to what Adam mentioned, then takes that into a slightly different space and has a somewhat different risk profile for clients who are wanting additional yield on top of that base level. And those have slightly higher risk appetite. And obviously the structuring of both the curation for that strategy and the risk management around some of those strategies that both Adam mentioned and previously is a slightly different kind of yield source, which can obviously be looped around or essentially generate additional yield on top of the baseline. For assessing all of this, obviously the legal and reg side is super important, especially depending on kind of what part of the stack you're looking to operate. And then also just seeing client demand, which chain, what type of applications are seeing growth, and where we see sustainable demand over a long enough period of time to make sense for actually building out those products in those areas, because they do take time and money and expense to be done properly.
Yeah, maybe to add on this a little bit on how we see things from a Byzantine perspective, what we do is essentially not taking necessarily a side on structuring the products, but rather building it around what clients are asking for in terms of liquidity, in terms of risk profiling. So we really are quite flexible in that side, because we believe that it's that flexibility that allows them to feel that comfortable with the kind of products. We work with multiple banks and multiple brokers, so it's very so those kind of institutions not necessarily know a lot about the ecosystem. So there's also a lot of explaining and walking them through this kind of products. In terms of opportunities, today we believe that euro yield is a little bit left behind. So today Byzantine is trying to pick up on this side of the world and starting to offering euro yield. But of course, on chain. If we look at it, where you can generate the most interesting yield is, of course, USD based. So today what we do is that we FX hedge it off chain to maximize the yield at all points, but still allowing to Europeans to invest without getting access to FX risks.
Excellent. And Ryan, anything to add there?
Yeah, I think one of the interesting trends is just the growth of the stablecoin market itself. And with that becomes scalability challenges for the yield. And so we're at this influx where we have sort of the tokenization of everything that is occurring. That's, I think, will ultimately be very beneficial for additional strategies as we see real world assets as its own category. It's almost going to become so big that it's going to need to be a lot of sub categories underneath RWA that are really so big that they're their own categories. So I think that's going to be the most interesting thing over the next couple of years. And as mentioned by the other panelists, it really comes down to the risk and liquidity. A lot of the sort of the opportunity, but also the challenge with RWAs is that there's often a stop and start type of flow because they are real world assets. You can't really predict that you're going to get a steady stream. And there's a lot of different variables that go into how to evaluate the risk for, what is the actual underlying collateral that's sort of supporting these mechanisms. And so I think those are the kind of the exciting opportunities that are coming up and where we'll see, kind of the scalability match where the market's going.
Excellent. Thank you all. Those are great answers. I guess the next natural question would be when you're structuring, or how do you structure a product so that users can access multiple yield strategies and reallocate them or reallocate between them easily and securely? I'm curious how this comes up. I'll start, again, we'll just round robin it. Ryan, I'm just going to go back to you. We'll go reverse order. I'm curious how your approach is to that.
Yeah, so we always look at a multi-strategy formulation, and we're looking at how to build a portfolio that in its aggregate will align to the sort of yield and risk profile of the market itself. And because it's multi-strategy, we may have significant portions that will be market neutral type of positions with some directional exposure. So the majority would be considered less volatile relative to the different levers of risk that are involved. But then you have directional liquidity. So that also gives you some opportunity to have short-term and long-term duration strategies within that mix. So I think that for us is something that we see a good fit for the market because it gives us more flexibility. We're not necessarily aligning to any one single protocol, any one single strategy. So that diversification helps to spread the risk overall because you never know, especially in the age of DeFi and AI, what is actually going to happen next that's going to surprise us. So you have to anticipate that there will be these unexpected things. And diversification is kind of just a base principle that we follow for that.
Got it. And Gaia, what are your thoughts on that point? I know Byzantine does a lot in the space.
Yeah, 100%. So to give you a little bit of context, what we do is that we have 4 flagship products, 2 in dollars, 2 in euros, but really for larger clients such as exchanges or banks, we build a set of products based on what they want. And today what we generally suggest, as is very complicated to show end user a single product, is actually to propose multiple layers so that the client, the final client, the retail itself can choose the level of risk that they're looking for. A little bit of what we've seen with Kraken, for example. They offer different layers of returns and therefore of risk, and then it's going to be up to the end client to decide how they want to get exposure and how they want to balance their exposure to this kind of strategies, essentially. So we try to keep it as flexible as possible. And generally, what we see is that this kind of players eventually go live with the 2 to 3 strategies with a low, medium, and high risk, and therefore a low, medium, and high returns, so that all kind of risk profiles are really covered. Aside from this, on the most, on some cases, what we've also seen is exclusively going for extremely low risk strategies. We work very closely with Ian, is one of the largest insurances globally, and we work with them on covering most of technical hacking, exploits risks on all our strategies. So we have some very risk-averse clients that just end up going for the most extreme blue chip and insure products, because I think it's just a matter of knowledge and also feeling comfortable to offering to end clients certain products rather than others. So yeah, we try to keep as a product approach as possible and just really giving the choice up to the user.
Excellent. Thank you for that answer. And then Matt, we'll go back to you, and then Adam, if you don't mind closing this question out with us.
Yeah, sure. We kind of see, I guess, the yields across 3 different buckets, especially at TruFin. So we have kind of duration-based real-world asset yield. So this is what I was talking about earlier around some of the yield opportunities which are coming from tokenized RWAs like treasuries, potentially private credit, gold fund, or commodities in general. We then have yield opportunities for crypto native assets. And this is typically where we're talking about, let's say, staking or liquid staking based yield for crypto native assets. And then on top of that, an additional layer of yield or different type of yield product is the curated vault strategies, which look to combine those 2 underlying products, both the crypto native yield opportunities, as well as those which are more real world asset and US dollar denominated, and then the kind of bespoke strategy vaults on top. I think to your question, how do we make sure that clients are able to kind of access each of those and make sure that they're able to swap between from a portfolio perspective? We do work with different vault curators to provide kind of the management of that if there is demand from certain clients. But also we just want to make sure that it's the same interface, the same permissioning, the same onboarding process, so that there's no repetition for that with the client. They onboard once, they go through that permissioning and onboarding process, and then they're able to access a variety of those different assets and choose the kind of strategy which is most appropriate to them based on the risk profile and based on what they're looking to achieve from a yield perspective. We really just try to provide them with the base level tools to fulfill their particular goals with that in mind.
Sorry, Lauren, you're on mute.
Yes, I was on mute, so sorry.
Okay,
Adam, any thoughts to add to that?
Yes, I think our answer is our dedicated client vault architecture. So how we've designed the architecture for our vaults is that each client has their own on-chain vault, one vault per client, and they have non-transferable vault shares. That vault can allocate to any of our approved strategies. So we have several distinct actively managed portfolios across WBTC, WETH, and USDC. And each consists of a blend of either direct protocol positions or curated strategies that we blend together and we actively allocate across. The reallocation happens inside the client vaults, so assets are never being moved outside or pulled together with other clients. So that's something we've worked hard to achieve in our architecture. So the client holds a DCV, we call them DCV, dedicated client vault, share tokens in their own wallet, and the vault holds the capital. So we hold the strategy mandate, choosing how we rebalance the client assets into our protocols or strategies, but we don't directly hold the assets, right? This is something that only the client can withdraw and redeem against. We have a strategy optimizer, which allocates across our approved universe of protocols. We, of course, have hard limits on protocols and per asset and per chain exposure, but the rebalancing is triggered by rate moves and other kind of threshold limits. And on the security stuff, how we rebalance it is super important. We've given it a lot of thought. So we integrate the use of atomic swaps for blended execution. So making sure that whenever we're doing a unwind or re-leverage or deleverage, we're building that transaction into a single atomic transaction to kind of reduce the chances of man-in-the-middle attacks or front-running, things like that. So it's a really important question from idea creation, strategy allocation to ongoing management, and then ultimately execution. And we try to build that all into our architecture.
Excellent. Thank you for that. And how do you decide when a client should stay in like a simple low risk yield product versus move into a more active curated vault? Is there any process to that decision making? Just curious, Adam.
Well, I would argue all of our vaults are curated in the sense that we are the curator of them, but there's different levels of risk that they can choose between. So there are more conservative portfolios, as I said, are more lending allocated to protocols or more complex strategies. But the client within UI can go in and choose if they want to switch to a different strategy, and that will automatically be picked up by our allocation engines and allocate them accordingly. So it's definitely driven by the client. They have the ultimate say on the risk profile. And if they had a certain mandate where they didn't want exposure to a certain protocol, we can also build that in. So it's quite customizable on a per client basis.
Excellent. Thank you so much. I'll move to the next question, which is pretty high level. But when you are adding a new yield strategy to your product, a new protocol, a new RWA source, what is the evaluation process before it goes live for users? Curious to know the different approaches taken by the teams on the webinar today. I will start with you, Matt, if you don't mind.
Yeah, no problem at all, Lauren. So when we're looking at, I suppose, a new yield opportunity and new yield strategies, and we did this kind of recently when moving away from just the liquid staking side of things, more into kind of tokenized RWAs under our true core products. One of the first and foremost things, obviously, operating in this space, and especially dealing with institutional clients away from retail, is an underlying kind of legal and structural review of the source of the yield and our ability to pass that through to the type of clients that we're wanting to service, and understanding what's actually possible with regards to kind of the appropriate regulations, kind of where is that fund based, what type of customers need to be onboarded, what are our own requirements as the kind of infrastructure provider in that space. And if it looks like something that is going to be possible for us to provide and bring on chain, then a lot of the focus then comes into kind of how are we going to integrate with some of the other partners in the space, what level of kind of back-end integrations and also smart contract build are we going to have to do on our side, and the feasibility of doing those and plugging that into our existing infrastructure. And once we've kind of taken a look and figured out that, hey, yes, this is kind of a yield or a product which we could offer to the existing clients that we have and those that we want to attract into the future, and we're confident that we can go out and build that. It's also then talking to and working with different partners that we have downstream. So some of the distribution partners, some of the yield partners that we work with for utilizing some of our assets in different strategies, and understanding their appetite for distributing those products, and also working with us with some of those yield sources as well. So really, it's quite a collaborative process, given kind of how many different touch points or how many other relationships we do have. But those are just some of the key considerations that we have on our side ahead of evaluating whether something should be launched or is a potential product which our clients would want, assuming that there has been sufficient client demand and interest at the outset to kind of prompt those discussions.
Got it. Excellent. That is a great answer. Gaia, I'll go back to you, and then Ryan, and then Adam, if you don't mind chiming in as well. I'm curious to hear each team's approach.
Yeah, 100% happy to give you a little bit of an oversight. So this is something that we actually run together with our curator, KeyRock. They're regulator under MiCA and here in Europe. And what we do is to run a 2-axis evaluation. So on one hand, the first axis is really on asset risk. So we run a 6-vector score on the collateral, covering essentially issuer quality, on-chain liquidity depth, protocol and smart contract risk, yield sources, the oracle mechanism, and the instrument type itself. So the score is really relative, and USDC on Aave is the baseline, and everything really gets benchmarked against that. And on the other hand, the second axis is really the concentration and allocation. So the maximum deployable size is capped, so that any new market can pass a risk review and still be sized at a level where we can exit cleanly, even if withdrawable spikes. And once both axes pass, then that change can go through, and even for those kind of changements, there's still a 3 days time lock. And this window allows client or independent counterparty that are sentinels to actually veto that decision, so that the client can really withdraw if they disagree. And really the key point for us is that nothing moves silently, and if there is a changement in strategy, needs to be agreed through parties.
Got it. Excellent. Glad you have great partners in that space. I want to go to Ryan now, if you don't mind.
So similarly, we use a scoring matrix
Okay.
where we look through all of the smart contract risks, try to understand what the underlying assets are, what is the performance been of those assets through turbulent cycles. Stable coins, obviously, they're called stable, but they're not necessarily always stable. So this is, an underlying aspect of all stable coins that has to be accounted for. And I think more and more the nature of DeFi is so interconnected, and not just interconnected to DeFi anymore, but also connected to the real world. So you also have to look at the overall macro environment and what are the systemic risks outside of DeFi that can impact the DeFi market. So even just a shift in technology earnings for NVIDIA can impact digital assets so much these days that single sort of variable, or what sort of cascading effect of, a trade war and things like that do have direct effect into the DeFi space. So it's really just a much more connected system of levers that has to be looked at. And I think more and more we look at sort of the unknown. We're in this time where AI is getting so sophisticated that it's finding exploits in code that haven't been found in 28 years in operating systems. So this is also something that you have to expect the unexpected, and make sure that you have not only sort of the risk profile, but you have the mechanisms within that protocol to actually see the triggers, the warning signs, so that you can exit, so that you're not the last one leaving, and maybe you're unable to leave. So I think those are kind of the, there's the spreadsheet view, and then there's the sort of actual real world scenarios that aren't always accounted for on the spreadsheet itself.
Great answer and good point. Adam, any thoughts to add?
Yeah, it's a great question on how we create new strategies, and it's quite a lengthy process, but I try to keep it brief. Nothing obviously goes through to strategy development unless it's been through a 5-step process of ours that we've developed. And the critical thing is that the research itself operates already inside a whitelisted universe that we've approved. So there's 2 key layers: is how a protocol enters the whitelisted universe in the first place, where we have some kind of protocol risk scoring methodology, which I've heard other people use as well, and then how a specific strategy inside that universe can get approved to be deployed in. So our protocol risk scoring system defines the eligible universe. It's a composite score that looks at things you probably expect, such as protocol maturity, TVL, audit profile, security history, all that good stuff. And it gives us a protocol score that we'll use not only to whitelist a protocol, but also to help us define the size within that particular strategy. So I'll quickly go through the steps. We first look at research. So of course, identifying the yield generating strategies within those pre-approved whitelisting venues. That's how we start. So screening liquidity, transparency, and operational robustness on those protocols. Then we've got risk assessment. So looking at the initial risk assessment before we deploy. So we're looking at the token risk there. So the underlying token dynamics for that strategy and the liquidity. How easy is it going to be to get out of that position if and when we need to? And then also the strategy risk. So looking at what kind of leverage we might take, if any, in that position, how we might set liquidation thresholds, exit liquidity, all these things that we're going to set as thresholds if we choose to deploy. Once we pass those checks, we then go into deployment. And as I mentioned, we deploy all of our strategies within dedicated vaults. So there's various vaults of different strategies, but each of these vaults have specific whitelisted venues, protocols, or assets that they can only interact with. So there's another layer of defense there from a security perspective. Then we have the risk engine. So once we're deployed, there's of course ongoing monitoring, right? So we pass stage one, but lots of the scary stuff can happen after stage one once we think we're deployed. So we have ongoing monitoring, which is continuous, around the clock, checking things like risk thresholds, TVLs, health factors, making sure that we are within our risk limits. And if we need to, we can unwind any position. So it's quite a complex process, which of course is more important than ever with the events of last weekend.
Yeah, no kidding. Great answers, everyone. I'll move to maybe a tougher question, I guess, or an interesting question where you might all have different answers. But what is the hardest governance or security problem you've had to solve while building out your products? And how did you approach it? Any stories there? I think a lot of folks tuning in would like to learn from the operators who've gone live and solved these issues. I'll start with Ryan, if you don't mind going again.
Sure. Yeah. So Coinchange has been around for over 5 years. So the evolution of DeFi and CeFi have evolved significantly in that time. So I think one of the biggest things is combining the technical infrastructure with the regulatory requirements. This is becoming more clear with each passing day, but it's still the nature of DeFi. It's decentralized. You have a lot of different moving parts. So understanding what the regulatory footprint is, reporting, these are all things that are take a lot of effort and on the surface seem kind of a lot more simplified, but as you dig in, there's many layers. So I think that's one of the most maybe overlooked aspect of just the complexity of how many different jurisdictions are involved, because this is, digital money essentially. And so it can be accessed from anywhere, and you can have people building essentially software that interacts with that from anywhere. So it creates a lot of infinite opportunity at the same time. So that's what makes all of the effort worthwhile to jump through all those regulatory hoops and to do all that work, because this is ultimately the most flexible, nimble form of transacting that exists. So that's kind of the takeaway, is that it's complex, but is worth the effort.
Great takeaway. Matt, any thoughts to add there? I'm curious to hear each of your answers on this question.
Yeah, sure. I think on that side, the biggest challenge that I think we face, but also is from kind of driven by clients, is the kind of the balance between permissioned institutional access for assets and for yield, as well as trying to have as much on-chain utility for those as possible. And so if we want the kind of those institutions to start to utilize those assets more on-chain, then those assets do actually need to be in some way, shape, or form, especially depending on the protocol, permissionless in nature. And so we solve that primarily through kind of minting and redemption, kind of KYC, AML flows, and making sure that only those that are on the whitelist are able to interact with our vaults, our contracts, and able to actually mint or redeem the underlying assets. But then those assets are permissionless in nature, enabling them to have as much utility as they possibly can, but also opening up the aperture to provide greater levels of liquidity as well. So I think it was Ryan who mentioned around RWAs and the underlying challenge with some of these around the redemption process and timelines for the actual physical settlement of some of these assets. If you're looking at private credit funds and others where up to 3-month redemption cycle in the traditional world. Obviously, if you try and plug that asset into DeFi and you're wanting somebody wants to come along and essentially instantly redeem that asset for their underlying stablecoins, then you need to be able to provide a mechanism for that. And having a permissionless asset on this side is one way in which you can enable atomic liquidity providers and other market participants to step in and provide that liquidity at the point of need, which is a much kind of improved system than in some of the traditional world. But it's definitely a challenge balancing the underlying traditional real world asset and the need and desire, especially in DeFi, for kind of on-chain composability and the utility that can provide. But it's a fine balance between the two.
Excellent. Gaia, anything to add there?
Yeah, 100%. Well, first off, totally agree with what just now Matt said. In my experience, what institutional users really want are mainly 3 things in like descending order of importance. First is proof that really nobody, including us or Kira, can move their money without them. And second is a role-based control on their own side, so that treasurers can really deposit, but only a board-approved signer can withdraw past a threshold. And the third and last one is really a paper trail for compliance that is really extremely important. So the first point we solve with architecture. Byzantine or Kira can really pause withdrawals, block anything, or force changes to the investment strategy. And is not just a policy, but it is encoded in the immutable contract. So all our smart contracts can't be changed. And the client holds the receipt token. So with full self-custodiality and or institutional custody, for example, via BitGo or Anchorage or wallets of their choice. And for the second point, we do not necessarily impose our own role model. General institutions already have one. So what we generally do is to enforce their rules about decisions and quorums, so that Byzantine can position itself natively based on what they want. And on the third layer, this is where we really invest a lot of effort. This is about being extremely transparent, and it goes through certifications, for example, like SOC 2, etc., but also giving access to any kind of data. So real-time position data, historical performances, or full collateral breakdown, so that who allocates and who makes the decisions, then they're going to pass on to the end clients, can really make those choices by having knowledge of where they're putting their capital into. That, I believe, is the most important thing for institutions, really.
Excellent. And then finally, Adam, I'll land with that, and then we'll move into a new section of questions, and then we'll get to some Q&A. Thank you to the audience for dropping some questions in. We'll get to them towards the end.
Sure. I think one of the hardest things we faced when building our vaults product was reconciling 3 things that normally pull against each other. So discretionary portfolio management, which needs execution authority, so we can manage the portfolio, of course, and client-owned custody, which needs the client to retain control, while also building in MiCA compliance, which ensures segregation of assets. So we spent some time trying to think how we could build this governance model from an infrastructure perspective, while trying to make it appropriate for on-chain allocations across DeFi. And so we approached it a few ways. In our infrastructure, we split our on-chain roles. So we have atomists, which are basically portfolio managers. which are only approved to allocate to strategies and rebalance them. We have roles such as guardians, which can halt contracts, for example, if there's a AML risk or something, we just need to halt all the contracts. And neither role can withdraw assets to another address. Only the client can use their vault tokens to redeem their assets. And that was an important thing we couldn't compromise on. The dedicated client vaults we built also have no commingling of client assets. So each client only has their own funds in that vault, which is relatively new for the vault world. Traditional vaults, everyone is pulled into a single vault. So trying to ensure there was a MiCA compliant version of that was difficult. But ultimately where we've got to. And non-transferable vault tokens. So the vault token is the economic token the client has to reclaim the assets from the vault. It's not an instrument we can rehypothecate or transfer. So that's important. And of course, the regulatory wrapper. So discretionary portfolio management under a CASP authorization is the framework that lets us have the mandate to rebalance that client assets from the vault while keeping them fully segregated. So that's the challenge we had and how we tackled it.
Excellent. Thank you all. And I'm going to run through some questions. I'll ask different ones to each of you specifically, and then we'll get to the Q&A from the audience. So I'll start. I'll just go backwards. Adam, I'll start with you. So once yield strategies are live, what does the operational layer look like? What are you monitoring? How often? What triggers intervention? I'm curious on that.
Yeah, that is absolutely key in the strategy we deploy. It's the ongoing monitoring. So we have ultimately 3 different clocks of monitoring. We have continuous, weekly, and event-driven. So continuous for position level risk. So for all the positions, we have systems that continuously monitor our thresholds and TVLs, things like that, or the protocols we're allocated to. And we have weekly monitoring for strategy rebalancing. So for high-level decisions, if we want to change our allocations across different markets or protocols, that's done weekly. But of course, if there's an event-driven reason for us to analyze, we will do that as well. And that, as you can see over the weekend, that was something that we had to do at the weekend. But continuous is probably the most valuable that we have. So in our continuous monitoring, we're looking at things like health factors on any positions that we have any leverage on, loan to value, thresholds, rate spreads, so spreads on our carry loops, market utilization, of course, so looking at available liquidity, how easy it is for us to get out of these positions. This is continually monitored, and it will also trigger certain behaviors in our vaults. For example, redeeming if we see the risk of getting out being difficult or liquidity drying up. And then there's, of course, protocol level risk we're looking at. So TVLs, are we seeing any significant drop in TVL? And what might that mean? Is it just a large person moving assets, or is it something a bit deeper? So we have protocol level thresholds, liquidity depth, governance events, things on Aave, what's going on the governance side, and what does that mean for us as an allocator? And then, of course, oracle behavior. So each of our vaults are linked to a certain oracle. Oracles can behave strangely at times. They can freeze. So making sure we've got backup checks continuously to ensure that the oracles are accurate are super important for our risk management. They're probably the most important aspects.
Awesome. Thank you, Adam. That was excellent. Matt, I'll move to you with a different question. Similar, what visibility do institutional users expect into their live positions, and what did you have to build to provide that, if anything?
Yeah, just covering that side of things in terms of visibility. So we at TruFin have a DApp and dashboard kind of displaying for each of our clients their kind of live position across any of the assets that they do hold or any of the yield strategies. If I was to break down kind of what they're primarily looking for, quite simply kind of real-time position and valuation. Obviously, some of these assets update more frequently than others. If you've got a real-world asset based on a treasury fund, then the NAV of that is going to get updated on a daily basis, and sometimes not even daily if it's not a dealing day. For others, which are kind of more crypto native, let's say liquid staking, then depending on the underlying chain, it could be kind of block by block updates in terms of the value of the underlying assets and the liquid stake tokens themselves, depending depending on the oracle and how frequently you're updating that. We're obviously wanting to also show kind of proof of reserves across any of the assets that we do have for clients. They're going to see, to Gaia's point, the assets and where they are currently held, the underlying address, and making sure that only they and their wallet, given all of our services are non-custodial, are the ones that can actually interact with and actually kind of execute against the assets, and kind of either take them towards different venues, or essentially kind of transfer those at the point at which they're wanting to do that. We also do have underlying data on some of the third parties that we work with. For the liquid staking side, this could be things like the underlying validator performance of the validators that we hand select and work with. But for others, it could be something slightly different, especially on the vault curation side, where it's a vault curator stepping in and having more of an active management of that strategy. And you might want to see which protocols they've deployed those assets to, and kind of what are the respective wallet balances, depending on the strategy that's being employed. All of that to kind of almost summarize as well, that you want to have all the information available for that client in a downloadable format, often via API, but we also have that kind of via reporting dashboards and kind of reports themselves that kind of user and client can delve into if they're wanting to get summaries based on different timeframes as well.
Excellent. Great question for you specifically. Ryan, I have a question for you. I guess, what can you offer users through DeFi strategies that you cannot replicate in CeFi, and vice versa?
Yeah, I think the biggest opportunity in the DeFi is what we see with the tokenization of real world assets, and as well as things like tokenized treasuries, money markets. This is definitely instant liquidity in many cases for a lot of these instruments, and I think we'll see a lot more interesting dynamics over the next year or two within that, especially if equities are becoming tokenized. I think that opens up a lot of opportunities, new financial instruments that will be created from that as well. So those would be I think the biggest advantages. Transparency would also be another piece of that as well. So eliminating of some counterparty risk versus the CeFi. So in some cases, that's definitely a mandate that people have.
Good point. And then, Guy, I'll end with you. Just curious if you think, do you think that the CeFi, DeFi distinction is becoming less meaningful for how yield products are built, or is it more entrenched? What are your thoughts on that?
Yeah, that's a great question. So I think that on a product level, it's becoming less meaningful in the sense that what the end user sees and what they experience is really a dashboard, an API, a regulated entity that they can call, statements that they can download, and these kind of things. But behind, on the back end, on the engine and what's underneath, then it's extremely different. So those are, I believe, two worlds that are architecturally further apart than they were 3 years ago. On one hand, DeFi venues have gotten more formalized, so like MiCAs and gas processing, audited oracles, and more mature insurance brokers that are coming on also on chain. And on the other hand, of course, also the CeFi actors have gotten more and more regulated, also post 2022 events. So each side, I would say, has hardened its own stack, both for DeFi, mostly on the regulatory, and of course, the insurance and security side. So that the bottom line is more interesting products for institutions are getting built, but the bridge still stands, and the differences between the two worlds still stands, mostly though on the back end, on the architecture itself of the product.
Excellent. And I think from the audience, we had a question specific for you when we were talking about risks, and I know you've mentioned Aeon and different on-chain insurance products and things like that. One question from our audience is to you specifically: how do you communicate the risks to the end user?
Yeah, 100%. So what is done is that, of course, the strategy is built with, for example, a neobank or an exchange, and then is up to them to showcase on their front end how something that, depending on the kind of users that they have, actually answers well, so that end users can take the right decision. On Byzantine's side, of course, is about transparency. It's about letting them know the kind of collaterals, the risk parameters and frameworks, and how decisions are taken in moments of stress. But at the end, it's an experience that the neobank has to show, and it's their job also to make their users understand how they're placing their money.
Excellent. And then I'll run through a few of the other questions that we've gotten during this section. I guess insurance has come up a few times, and I think the audience is curious to hear from the operators in the space. What insurance coverage, I'm reading the question, do you see? Is it notional insurance versus notional insurance exposed? I know we've mentioned some big insurance providers that are coming on chain, or getting into the DeFi space. Curious to get your thoughts on that. Ryan or Matt, I'll start with you.
Yeah, so we utilize a number of different insurance layers within the providers that we work with. But ultimately, I think for our type of mechanisms, a lot of times it's active trading. So there is an insurance product for active trading. But for other things like smart contract risk or wallet keys, things of that nature, I think those are mature enough where they are almost like industry standard or expected at this point. I think we need definitely more insurance providers in the space. There's been some that have come and gone, and it's, I think, just trying to get that product market fit established because it is evolving. So hopefully we see, continued evolution in that space.
Excellent. And Matt, anything to add there on the insurance topic? And we also have some questions on licenses, which I know is a big question that we've sort of touched on a bit. So anything to add there?
Yeah, happy to just quickly add on there. So at TruYields, we're just an infrastructure provider. So we don't actually take custody of the user's assets or kind of run bulk curation strategies ourselves, kind of taking on active management. So the insurance piece may look slightly different for us versus maybe some others on the call or others with a slightly different role in the ecosystem. Ours relates more to kind of your traditional cyber and tech related insurance products, where it would be a failing of the underlying technology itself, i.e. the kind of the vault infrastructure, which we would be providing to clients, or that's utilized similar to kind of other tech related insurance products, kind of similar or analogous to the traditional world outside of crypto as well, which is maybe somewhat different from, if we're working with certain vault curators and they are actively managing a pool of assets, they will have, a slightly different level of insurance or a different type of insurance, as well as licensing as well, which probably leads into the following question. But the licensing part, again, is probably less focused for a business like ours, but it is obviously very important for those that are wanting to take on more of an active role, taking control or custody of users' assets and providing more of an asset management layer on top of the curation strategies.
Awesome. Adam, anything to add there? What is your approach, all things insurance, licensing? These are big questions when you get started. So I'm sure you've had a lot of learning experiences along the way.
Yeah, on the insurance side, I mean, unfortunately, there aren't many options in DeFi, right? And I think historically, we've seen that the options that there have been haven't really covered you for the things that you'd hope they cover you for. So there's a lot of room for growth and development on the insurance side. But with exploits, changing so significantly year to year, it's going to be difficult to get a holistic insurance product that isn't going to cost the earth. But we're still reviewing them regularly to see if there's something like that can really fit the bill for what we need. On the licensing side, we are micro authorized in Finland, so we have the micro regulatory authorization to do our portfolio management activity for clients. So our product is targeted only at institutions, so large institutions that care about the micro authority and an authorization element of it, that don't want their assets pooled with others. So, our stance has been that the traditional kind of curator model where pooled assets they're pooled, many of those asset managers don't have the appropriate authorization. So what we've tried to do is a more compliant route, but arguably targeting different types of clients. So, our opinion is that both types of curators and asset managers can coexist, but target different types of clients. And we've tried to position ourselves for more the institutional angle for those that do care about the segregation of assets and authorization. And that's where we are currently.
Excellent. Great answer. Gaia, anything to add there? Or Ryan, I know licenses, insurance, or I'm Gaia mostly. I'm curious since we haven't touched on this with you quite yet.
Yeah, 100%. So I believe that I completely agree with what Adam says about on-chain insurances. I agree that it's for institutions that are not familiar with how DAOs work, etc. It's very complicated for them to trust such insurances, because fundamentally there's no one you can call, right? And also not necessarily a policy that is followed, is rather votes from a DAO, so it's very complicated to trust such processes. So today what we have focused on is really exclusively off-chain insurances. It took us quite some time on explaining various insurances, how smart contract works, how we build, how the risk framework works, etc. Of course, that touches on the returns that are generated, but we also saw that for some more risk-averse clients, it doesn't really matter. The point is really having this coverage so that they don't get affected by hacks or exploits. And so we, on that end, we ended up relying exclusively on off-chain insurances for this specific reason, because otherwise you don't have anyone to yell at when something happens. So on that point, this is my point of view. And on licensing, fully agreed, is extremely important. So what Byzantine builds the infrastructure and puts together various parties. But Kirok is the one that does the active management, and they are regulated. We believe that for banks or very regulated players, this is a necessity and can't really be worked around.
Excellent. And I know we're getting towards the end. It's been a great discussion, but I do have one closing question for each of you. I'll ask the same question to you all, sort of a lessons in hindsight question. What do you know now about building and operating a yield product that you maybe wish you'd known when you started? Or another question would be, what is a common mistake that you're seeing teams make when they go from planning a yield offering to actually shipping one? Feel free to answer either or both. I'll just get your closing thoughts. Ryan, I'll start with you.
Yeah, I think for us, it's always kind of the consolidation of reporting. There's always new protocols being made available. There's upgrades to protocols, new smart contracts. These are all, things that have a lot of complexity to them. So, in getting them in a usable format within your own internal systems and dashboards, and making them available to external audiences as well. So I think that's one of the things that is maybe one of the biggest hurdles within maybe the DeFi, CeFi space, is just that the data isn't really normalized. You have so many different ways in which to consume the information versus traditional markets. There's standard formats that everybody operates on. So it's a little bit more effort to get everything, to take advantage of these different venues and opportunities that are there.
Excellent. Matt, any lessons learned or common mistakes that you're seeing in case we have any people in the build process tuning in?
Yeah, I wouldn't go kind of too deep on mistakes. I don't want to shame anyone, but I think there's certainly a big difference between building out yield products which are crypto native in nature and having kind of everything available on chain 24/7, able to be queried in real time, versus building out products which are bringing kind of off-chain yield opportunities like tokenized RWAs that we've obviously focused on during this discussion, and figuring out a way in which you can make those composable in DeFi and also just interoperable across the stack. So thinking very clearly around how you deal with NAV or net asset value, which only resets every dealing day, and understanding, okay, what are the public holidays and what do you do if it's not a dealing day, and all the different kind of intricacies that the traditional world has dealt with for generations, but kind of figuring out how we map that to a world where we're wanting to put more and more of these assets on chain and to kind of marry the two together. So figuring out the integration between those different product sets at TruYields is definitely one of the biggest challenges, and making sure we nail that piece to make sure the products perform as expected.
Excellent. Adam and Gaia, we'll close it out with you. What lessons learned, or hindsight, whichever you'd like.
Yeah, what I wish I knew when I started. When I first started in asset management in DeFi, I thought it was all about the idea, strategy generation, strategy ideation, even finding the clever trade, designing the structured positions, and optimizing a carry and all that good stuff. And what I learned is that the strategy design is maybe like 20% of the product. The real 80% is the risk management side, and that's becoming more and more apparent in DeFi as we see AI take off and exploits becoming more and more common. Because if you're running a DeFi portfolio, targeting 5 to 15% for argument APY, the expected loss in that portfolio has to be super small, right, to make the risk-adjusted returns work. Otherwise, it just falls apart. So the conditions that produce losses in DeFi, things like protocol events, governance changes, all these types of things, don't wait for a weekly committee. They need automated responses wide in ahead of time with predefined triggers. So having risk management at the forefront of everything we do is absolutely paramount now. And that's very different in DeFi than CeFi. So my background was in CeFi. We have very different risks here in DeFi. And having foresight of what can happen, which is one of the hardest things. We're looking at hypernative and integrating those into things we do. It's super difficult. How can we define those triggers? Because every trigger could be totally different each time there's an exploit. So just reframing it where, we're caring about the risk and trying to prevent the loss as opposed to trying to make some fancy product with a high APY. That's how we try to think about things.
Excellent insights to share. I appreciate that. And then Gaia, I'll end with you. Lessons learned, hindsight, whatever you'd like to share.
Yeah, 100%. So something pretty similar, actually. So at the beginning, we've understated how much work is actually on the trust architecture and not necessarily on the yield side. So when we started, we overweighted the question on how to generate attractive yield safely. And that turned out to be the easier half. The harder half is how to make the system believable to a counterparty who has essentially every reason to be skeptical. So I think that has been the biggest challenge.
Excellent. Again, we are pretty much out of time, so I will wrap this up and give you all back the rest of your day. But thank you so much for joining. Thank you to the audience for all of the great questions. A lot to learn from all four of you. And thank you so much again. I hope everyone enjoyed the session and learned a lot. I know I did.
Thank you.
Thank you very much.
Thanks, Lauren. Appreciate it. Thanks, everyone.
Bye.
Bye-bye.